This is episode 57. I'm gonna remember this time around. Of
Wow.
Exit Liquidity. We have got Kellan from Parcl here today. Kellan, thanks for joining us, man. We've been looking forward to this one for a while. Definitely think the timing worked out in our favor here. You guys have a lot of fun stuff cooking up, and it's definitely a privilege to be able to break some of that or to talk about some of that live with you. Just to get
Awesome.
started
Thanks
here,
for
we'd
having me.
love to yeah, absolutely. We would love to start out just by hearing a little bit of who you are, what your background's like. I actually don't even know myself, even though we've talked before. You alluded to it a little bit at the start, so I'd be interested to hear more about where you've been.
Cool. Yeah, happy to. And thanks again, guys, for having me on. Lucky number 57. I'm honored. Yeah, so my background, I I started my career in what I would call traditional finance, a bit of a unique path, I guess. Right out of university, I started at a market research firm tearing apart cell phones and identifying semiconductors. So I spent most of my career before Parcl covering semiconductor companies, so tech hardware. I then went to a global investment bank doing equity research, so a little bit closer to public markets. And then third stop was at a hedge fund, market neutral, long short, also trading tech stocks, primarily covering semiconductors. And that's kind of where I was closest to kind of markets and trading. And that around that time, I met one of the co-founders, Trevor. We started idea, brainstorming, generating ideas around this concept or some derivative of this concept, which was effectively to get exposure to real estate markets in the most liquid way possible, to trade them like you would trade any other liquid asset, stocks, crypto, etc. Because real estate is the largest asset class in the world. It often has the best risk-adjusted returns, and it's also the most illiquid. So that was the journey, and it's been a wild ride, but it's been very rewarding.
Awesome. Yeah, definitely a lot of cool experiences there. We usually like to From there we usually like to focus a little bit more on your crypto experience. So
Yeah.
it's a rite of passage that we can't really start the episode until we hear your favorite Exit Liquidity story of when you were Exit Liquidity. Um, Tell us a little bit about that.
Yeah. Yeah. I left that part out. I thought you might be going there. So by nature of, well, let's go all the way back. Bitcoin, I was effectively created or launched right on the backside of the financial crisis, which I think actually there's a lot of ties here, especially, to Parcel and the product itself with the association of real estate in that period of time. It's just very, there's some ironies there and a lot of overlap. But I remember, I was terminally online pretty early. Reddit was a huge thing back in those days, at least for me. So I was in all these, message boards, Wall Street Bets before there was really anyone in it. I mean, it was popular, but not like it is now. And so I learned about Bitcoin effectively that way. And I was like, oh, this is very interesting. I just read Matt Taibbi's piece about the vampire squid and Goldman Sachs and the real estate crisis and the financial crisis that spun out of it. And I was like, this is interesting because, I knew enough at that time about how markets work to understand that, that over the history of the world, fiat currencies get debased. That's just what happens, and Bitcoin, effectively the core premise was this is a antidote to that. It may not be a cure, but it's an antidote. And so I got kind of indoctrinated. I learned enough. I'm not an engineer and I don't write much, if any, code. I've tried to teach myself a little bit, but so that was kind of that was my start. I actually bought a Bitcoin in a park in Boston. I don't know if you guys remember this. You could there was a service where you would meet up with people and exchange cash for Bitcoin. And so I bought a couple Bitcoin for a couple $100. I don't know. I have no idea what I did with them. Probably I was one of the people that probably paid for them with pizza or something, paid for pizza with Bitcoin. But and then some time went by, nothing really happened for a period there. Coinbase kind of sprouted up. and I remember I was one of the early users of Coinbase, not like super early, but early enough. And then in the 2017 timeframe, like that bull run, when programmable money started to be like a concept, right, with Ethereum, and there was the ICO craze and all this stuff, and I kind of re-engaged, and that's probably when I was my first experience being Exit Liquidity, on the other side of that I guess that mini bubble bursting, and I bought a bunch of Ethereum all the way up. I don't know if I lost a ton, but I didn't get out at the right time. But what was interesting is that as a result of my career, I had to do some deep dives into this technology to understand the impact it would have on chip demand, right? GPUs and ASICs, and specifically proof of work. And then that kind of played out over the remainder of my prior life, my prior career, and so I got a pretty good grip on this technology, the size of it, how it worked, and it gave me a really good starting point for when Parcl was first being conceptualized, to understand how this product would best be delivered. So that's my journey. I was Exit Liquidity in 2018, probably, along with some of my family that I walked off the cliff. But I think we're in the black again, which is good.
Yeah, you talked about that period of ideating on this product that is now Parcl. Leading up to that, you also talked about the risk-adjusted returns of real estate, like throughout history. What has like that real estate narrative looked like in the beginning, in the first innings of its like alignment with crypto, or its intersection with crypto?
Yeah, it's a great question. I mean, fundamentally, real estate is one of the original and most consistent inflation hedges, right? So that alone, there's some overlap, especially with the core premise of Bitcoin and self sovereignty, and like that. I think there's a lot of similarities there. It's also the most widely adopted asset in the world. Everyone has a relationship with real estate. So if you're looking for ways to onboard people to crypto, what better way? Like, and that's really how we think about it, as the developers of the Parcl protocol. And but it's a big bridge to cross. Real estate is a very understandable asset, and it has very purposeful utility. It's a place where you live. It's shelter. Everyone was born somewhere, they grew up somewhere, they lived somewhere, they visited somewhere. So to kind of make that bridge to something on chain, something that's synthetic, something that you're just getting exposure to the price of a region, that's a significant leap. But because the core underlying is so understandable, we think it's one that's possible for the majority of people. I think the one other thing I'd mention is like tokenization of physical properties, and fractionalization of physical properties has been a concept that's been around for a while. It's never taken off, right? It's really hard to scale, and it's hard to market, right? Because you need to have a property that speaks to enough people, or a collection of properties that speak to enough people, to kind of onboard them and get them involved. And that's just really hard to do. Like typically it's just a house somewhere, or like this condo on this street, and you look at it and you're like, I don't know, like maybe not for me. Whereas when you look at a city, the way that Parcl presents it, that's way more understandable. There's so much like memeability there. So I think that's one of the reasons. So I kind of have made 2 points. One is that there's actually a lot of similarities, and it's a great on ramp, real estate. The other is that it's classically illiquid, and that going bottoms up, the way that tokenization and fractionalization has to date, is just real. No one's broken through. We haven't gotten through the great filter on that. Perhaps Parcl might be the right delivery mechanism. You go top down, get a bunch of users, establish a brand around real estate, and then you can do the tokenization. Who knows? So I think that's I guess that's good context setting. I'll pause there, see if you guys have any follow-ups, but that's how I see it.
Yeah, I think you hit the nail on the head, and you touched a little bit on what is probably like a North Star for Parcl in the long term. Can you take us through those kinds of early days from idea to execution? And can you touch on why Solana specifically?
Yeah, for sure. Cut me off if I'm rambling. This could be a long one. But so early days, it's important to remember 2020, which I think is fresh in most people's minds, but maybe not. It was a crazy time, and especially if you were like, for people that were in a markets role, there was so much volatility. Every asset class, things were limit down every day in March of 2020, right? In public markets, it was bananas. And then at the same time, you have this phenomenon around the world where very quickly people are realizing that their relationship of where they work relative to where they live, or where they spend their days relative to where they spend their nights, has flipped on its head, right? You can now, especially in America, it turns out this actually isn't a huge, it's not as big of a concept, I think, internationally, but in North America, it still is like a big thing. People kind of there's just a lot more people working from anywhere. And so we looked, Trevor and I were looking at that, and we were like, there's all these like structural shifts that will take 5-10 years to play out. And the core theme here is like, now people can live almost anywhere, and it doesn't have as much of an impact on their their work life, et cetera. And as a result, we expect to see people moving to places that are more desirable, better weather, better quality of life, et cetera. So the original, like the Genesis trade that we always say, is we were looking at this situation, trading tech stocks, and we were like, man, the best, and we looked at a market neutral hedge fund. You look at risk adjusted returns. What you care most about is your Sharpe ratio, right? Because you have to be long in almost equal size as your short. And the fund we were at didn't tilt at all. So you need to short losers and find the winners and get long the winners. So we looked at this real estate situation that was developing, and we're like, oh my God, we got to get long Miami, and we got to get short a place that people are leaving to go to Miami from, New York or San Francisco or whatever. Not like it wasn't like a genius trade, but it was an obvious one. But there's very few ways to express it, especially on the short side. Almost, there's no way to express that trade until Parcl came along. And we started thinking about, like, why isn't this possible? Why is the largest asset class in the world so illiquid still? It's 2020. Well, at the time, 2021. It's there's $300 trillion of net asset value in residential real estate, and there's no good way to get these trades on. And so we started both like fact finding, what was the history of, had people tried this? What are the options? Where are the issues? What are the barriers? Realized very early on that it was primarily a data problem. Like there needed to be a really good real-time data feed for real estate, and that just didn't exist, which was kind of surprising. Most of the benchmarks have been around for 30, 40, 50 years. The primary one in North America is called the Case-Shiller Index. We can talk about that later. It updates 12 times a year on a 2+ month lag. That's not a tradable product. Even if you abstract away all the other issues, how do you trade something where there's no delivery? Like, you can't trade something on a 2-month lag that only updates 12 times a year. That's just like really tough. So we kind of got to work on okay, how would you solve this problem? How would you create a data feed, and is it even possible to have something that would update effectively in real time, daily, and be super representative, like not be noisy, right? And be a good representation of what's actually happening in the real world. What are people doing in these markets, buying and selling homes, changing prices, etc. So I'll leave that one, and then I want to talk about the other part of your question, which was why Solana. I think so the data problem was obvious. Then it was like, what's the best way to deliver this product in a financial architecture? And in the traditional financial system, effectively the existing rails were limited, right? It's cash settled or physical delivery, futures or options, with strikes and settlement dates. The rolling process is challenging. So we started to think about, well, blockchain and specifically DeFi is having this renaissance, or it's like breakthrough moment, or that's what it felt like at the time. Solana was a big part of that. I think in some ways for the wrong reasons, right? FTX was a huge part of that. But at the core, the technology was there, and we evaluated Solana from like the perspective of an investor, right? Like, what is this thing trying to solve? What is its likelihood of being able to do that? And what does it mean if they're right? If everything that they're trying to do plays out, what does that mean? Well, it means global availability of capital, instantaneous transactions, in really strong throughput, which is effectively a function of Moore's law, which is a concept that I'm very familiar with as someone who covered semiconductors. That's a hardware problem. And Anatoly worked at Qualcomm. And so like the way he was speaking, I was like, oh shit, like that checks out. And his intent was to become the NASDAQ on blockchain. He's been saying that for 4 years. And we were like, well, if that's the case, and you have a product that references a low volatility asset that in the real world has a lot of friction and extraneous costs, and we want to take those away. This should be on the NASDAQ blockchain. It should be fast. It should be cheap. And it was a big bet at the time. Solana was like basically in early beta, and we didn't realize how big of a percentage of activity FTX was. And it's as a result, it was a bumpy ride, as we know. But the technology theses remained the same, and they never changed. And they were getting better with Fire Dancer in particular, like the second client. The network has been much, much more reliable over the past year. And you could see the early signs of that, 2 years ago. So that was the thesis. And we effectively got to work building around these DeFi architectures, always on top of Solana's, network layer. There's been a couple iterations, which we can dive into. We're now, Parcel is now on the third version. And we think it's the right version or something very close to it. I've talked about this with Ali. And yeah, so I think I rambled, but I'll cut it there.
Yeah, great stuff. I thought about cutting you off for a second, but I was captivated enough to see that through to the end.
Sweet.
Yeah, no, I mean that all totally makes sense. On this show specifically, we've long had a bit more of like an EVM bias, but I think over the past like 3 or 4 months, we've definitely done an effort to have more teams on Solana come and talk to us. And that's one of the things we always ask. And the answer always kind of comes out to some color of what you just alluded to. I want to get a little bit more granular from there as to like more Parcel specific stuff. I want to hear a little bit more about how it works, specifically like number one, the pricing, and number two,
Yep.
like the actual liquidity mechanism. Starting off with the pricing specifically, because I think up until more recently, most people kind of just saw Parcel as like, a perp dex that trades a novel thing that is, like any other on-chain application, I think. But with what you guys are doing at Parcel Labs, which to me is like the more exciting, the more like broadly applicable component. That's like something that almost no like existing on-chain applications really have right now. Can you speak a little bit to the problem you guys are trying to solve with regards to pricing real estate?
Yeah, for sure. Yeah, I kind of introduced this in the last answer, or maybe the one before that. Parcel Labs is the subsidiary of the Parcel Development Company that is the real estate data and analytics and entity. And that was necessary because of the reasons I kind of alluded to, which is like the existing oracles, we'll call them oracles. People in like traditional finance and especially people in the real estate space have no idea what we say when we're talking about oracles. But maybe they'll start learning. But the existing data feeds, indices, oracles, whatever you want to call them, it was shocking how legacy they were. Certainly at the tech stack layer, we're talking these things were created 50 years ago. Many of them have been rolled into these large bureaucratic entities, and we know what happens when that happens. Like the magic kind of gets sucked out, and the innovation slows, and these things get ingrained into the existing system, and then nothing changes. So And I think the reason why there was an opportunity on the data side in particular, and why was there an opportunity for Parcel Labs? Because there was never really a commercial use case to create this real-time market level pricing. And Parcel, the decentralized application, the protocol, the perp stacks, created that commercial use case. And then you start to see all of these other reasons why it would be good to have real-time residential real estate pricing, assuming that it's representative and trusted, et cetera. And that's opened up Pandora's box for Parcel Labs, right? And it creates this very interesting flywheel within the real estate ecosystem where there's now a liquidity venue, and there's this data that underpins it, and that data can be repurposed to provide insights and all sorts of other stuff. So that's kind of the background, and I'll get into the details on which I think is the core part of your question, like how does this work? Parcel Labs spent about a year, maybe more than a year, in like an R&D phase, right? What is the existing stuff? How is it? What's the methodology? How much can we glean and understand? Also, what are the data sources? What's available? How can they be aggregated? How can they be deposited into a modern tech stack, a modern data warehouse with all of the relevant tools? And so that was the mission. Architecturally, the price feeds look pretty similar to some existing stuff. They're just better and faster. They have more coverage. They ingest way more sources. They're modern, and they update daily. And there's 2 points I want to make there. One is I mentioned that let's just use the Case-Shiller. It's just the easy target here. The Case-Shiller was developed, like I said, 50 years ago. The methodology is repeat sales of single family homes, no multifamily. Condos are not in that index. Think about how much the country has changed over the last 50 years, where multifamily homes are now a much larger percentage of real estate activity. So that's like a fundamental thesis. And we started running some numbers and doing some analytics once this data, once Parcel Labs had this data, and we realized that the Case-Shiller, in many cases, covers barely 50% of what we thought was the true market. So that was an obvious opportunity. And that was something that validated the thesis, right? And I had a second point. I've now forgot it. Maybe you guys can trigger my memory here. But maybe I'll pause there and see if you have any follow-ups, Ali. It'll come back to me if it's important.
Yeah, I think the balance here is Ali understands this a lot more than probably I do and a broader audience does. In terms of, I wanted to ask a little bit more, or maybe you can describe a little bit more on how the calculation makes it, or how the calculation of the real estate is specific to Parcel and how it makes it on chain. I understand like it's an oracle, but I think you can give a high level explanation. Maybe people will understand it a lot better.
Yeah. So I think this will trigger my second point, I hope, because I think it's related. But so there's a number of data sources, many of the same ones that something like the Case-Shiller uses, right? Government data, county records, tax data. These things are all publicly available information. And then there's like the modern data, right? 10, 15, 20 years ago, real estate and all sorts of other data was modernized and became digital. It was brought onto Web 2. There's now these listing aggregators. You play this out in any industry, this has happened all over the place. So those are now publicly available in almost all cases. And then there's all these like tangential data sources. So what Parcel Labs does is it just ingests all of that into a huge data warehouse, and then runs specific methodologies. What it's looking for is to find the most representative price for a given market. So there's plenty of parameters. What matters here is like data availability. There's like a minimum threshold, right, which we call institutional grade. There's like how many transactions are there? What's the throughput? Is this a sparse market, or is it a healthy large market? The higher you zoom out, you get more data points, obviously, which improves accuracy, improves representativeness, and those all effectively, for the purposes of the Parcel price feed, what you see on the trading application spit out as a median price per square foot or square meter, or globally. And that's we think the most representative way to look at real estate and compare it market to market, right? If you think about it, like price per square foot is typically very, very high in, the coastal cities. I'm talking North America, or like, blue chip global cities. Well, why is that? Well, A, demand, everyone wants to live there. B, there's typically not much square footage, right? It's like supply constrained. So that's like both the numerator and the denominator are kind of have upward pressure. Um, and you see that play out. Anyway, I'm off topic. How does it come on chain? So Parcel Labs is the primary and today only publisher of these parcel price feeds, right? It's proprietary. That could change over time. I think, one of a key criticism here that we hear often is like, well, is this sufficiently decentralized? Where's the redundancy? Is it manipulatable, et cetera? All valid criticisms. But today, it's Parcel Labs is the primary publisher. Parcel, the kind of the entity that controls the trading application, is the primary validator. It's a custom or forked Pyth Oracle layer. So these price feeds get published every day. They come in, they go through this custom Pyth implementation, get validated, and then they're on chain, and that's the reference price, the index price. I'm going to pause there. There's plenty of other stuff that happens after that, and how the liquidity shows up, and how the markets get made, and what people are actually trading, and the balancing mechanism. So I'll kick it to you guys to dive in wherever you want.
Yeah, I think that's the kind of second part of the exchange itself, the liquidity mechanism. Could you kind of break down how that works?
Yeah, it's a great question. And again, like history is probably helpful here. I mentioned third version. The first version of this thing, I think this will speak to you guys. Like we didn't know what, like, this was a completely novel, and it was unclear what the best way to deliver this was, and especially like trying to think through the backward compatibility. Like, if you play this out, there's trillions of dollars going through here. Institutions are using it. What's the best architecture? And we started probably about as far away from the best place as possible. So if Solana was the right decision for the layer one solution and low cost and high throughput, and that was a bet that has turned out, at least apparently, to be an accurate one. This first model was like a over collateralized debt position, like a CDP vault, where you would deposit, the LPs would mint tokens that represented the index price, and then pool them into an AMM, like a VAMM. And the problem there was that there was no balancing mechanism, and it was really complicated to get short, which was like the primary thing that was trying to be solved for. So very quickly we realized that was not the V1 was not the right implementation. Got to work on a V2. This V2 was inspired by some stuff that was happening in the EVM ecosystem, primarily at GMX, which was like a PVP model. So you have a lot of the same concepts. There's a role for liquidity providers. There's this like virtual AMM where the pricing's on a curve, but it was really like kind of head to head. And the big problem we realized there was that skew was not solved for, right? Like pretty quickly we saw these things just like really skewing hard, short, hard, long, like 90+%. And so I've talked about this with Ali, like who's at risk there? The LPs. Like they're underwriting those gains that are underfunded, right? If everyone's on one side and they're right, and they all go to cash in, who's footing that bill? It's the LPs, and it creates some permanent loss, and it's just a bad experience. And we're talking like a low volatility asset here, so the LPs are really underwriting all of that risk for the reward that's trading fees on real estate, and they were low for a lot of the same reasons we chose Solana. So that was a big problem. We got some really good feedback from some power users, a couple of people that were cleaning up. So even against their best interest, they were like, hey, you guys, you should take a look at this. And then that kind of informed this third version, which is much closer to, it was bet, right? It was like a perps dex, where the LP role here is still, some sort of a hybrid insurance fund. I've talked about this with Ali, like, there is that risk of under collateralization is still in existence, but the architecture of the exchange, which is actually quite conservative, I think there's over time room for that to be brought down a little bit. It almost like demands balance, right? Like equal side, long, short, right? Because the funding rates and the slippage, the price received at the trader level, plus the fee structure, which is a maker taker fee structure, anything outside of like really tight to 50-50 long and short, it doesn't make a ton of economic sense for the marginal trader, and that really protects the LPs. And performance to date in this exchange has been really great. Now, and I'll end here because I'm sure you guys have questions. The challenge with that is like, okay, well, what about the black swan? Let's say that something crazy happens. There's like a hurricane bearing down on one of these markets, and skew goes nuts, and let's just play that out. Funding responds very quickly. The funding rate responds very quickly, and the price received by traders responds very quickly. The LP should all be roughly protected here. The one thing we've seen, and this is like the only caveat, is traders tend to realize gains. Traders with gains tend to realize them faster than traders with losses. So the LP pool is kind of constantly running this like negative carry trade against that backdrop, right? Terminal, in a terminal state, the LPs would receive all of that, right? If this thing wound down and everyone had to close their positions, all right, then we're going to balance out. But the LPs are kind of funding this like negative carry trade. It's not massive, but it's in the 5 figures. And so that's one thing that we need to think about. But all LPs to date have at least modest positive yield, which is great. We'd love to see that. I think there's room here for the fees to be raised, particularly taker fees, right? Because those people are making skew worse. So I'm gonna stop there. There's probably plenty to chew on. I'll kick it to you guys.
Yeah, no, definitely. That's great. I'd like to. We've had this, like me and you have had this entire discussion asynchronously before, but I think it's definitely interesting for. I think like addressing kind of what my initial concerns were when I first found Parcl is like an interesting thought experiment, especially because like we've had tons of different perp dexes on our on Exit Liquidity before, and we've talked about different liquidity models and the risks associated, and kind of how you can properly mitigate that and protect everyone involved while still like having a good trading environment and a profitable LP experience. I guess like just for simplicity's sake, when I first found Parcl, the very first concern that I had was, we've seen virtual AMMs, under collateralized AMMs blow up as a result of not having a direct counterparty for things like funding or for things like any given trade. And I think you remember, I kind of just wrote it off at first after learning that.
Yeah,
can you explain
to bring you back into the conversation?
Yeah, I'm glad you did. Definitely. What's your like response to that?
Yeah, it's an important point. Like, there needs to be a strong degree of confidence in the stability of the architecture, right? Otherwise, then the risk reward calculation is all wonked out, and you have to pre-plan, right? Like, there's these scenarios that you just can't model, right? I'm sure, like 2008 is a great example. We'll just use that. I mean, it's a wild man example because that was an awful time and it almost collapsed the global financial system. But like, there's these tail risks that can create market structures that are not just like so far out of. There's so many standard deviations out of like what you'd expect that you need to effectively model for them. And I think that there's some core things here that this product has made like super paramount. One, the only collateral asset here is USDC. You are trading real estate values against dollars. So that takes away. So that because there's no other foreign exchange risk or token exchange risk, that takes one part of the impermanent loss calculation out of the system. And there's been plenty of people that have asked for this. It's like, hey, can I deposit Solana? Can I, why can't I do this? Why can't I do that? It's like, that's an unnecessary risk to introduce. And there's also plenty of other things in the infrastructure, the crypto infrastructure, that lets you do that, right? You can go in Solana and lend your Solana, your whatever network token on MarginFi or Camino or Solend, and borrow USDC against it. We'll let that happen there. And right here, you're just trading real estate prices versus USDC. The other thing is so that removes risk, right? But you can never get this risk to zero and still have a usable product, right? You can just get it as low as you possibly can, and protect the LPs as best you possibly can, and protect the traders. And we think that that's the situation here. We think that the risk reward calculation is somewhere close to sustainable, right? I think fees, trading fees maybe need to go up a little bit. Maybe there's something that can be done when there's more progressive decentralization and there's an ecosystem token, and there's incentive structures that can add some juice maybe. But in the meantime, like the focus is making the core economics of this product sensible for every participant, while against the backdrop of the risk. And I think that the last thing is, like, it's important. You have to be transparent. And this was good feedback that you had, Ali, like, and a couple other, like, what I would call sophisticated or, thoughtful users or people that just had some feedback. It was like, you need to provide the resources for the average trader to understand what they're getting into here. What are funding rates? What can happen? What's the mechanisms that determine funding rates? There's this concept of funding velocity, and we can get into that. What are the LPs exposed to? What is their risk? What can go wrong? How could I lose money as an LP? So personally, I've made it a big priority. This is still a decentralized or mostly decentralized application. What is my burden? It's to provide as much information to the users as possible, right? These are at their core, they're sophisticated products, and not every trader is sophisticated. Not every LP is sophisticated. So what are they walking into? And I think we've done a decent job, or better than decent job, at providing that information, both through the documentation, through bespoke education via Twitter threads, through these podcast appearances, through I think that the information's out there, and I'll end with this and I'll run through it. I think I've kind of given it, but like, as an LP, what are your risks? You are underwriting the net P&L of traders, right? If there is skew and they are right and they all recognize their gains, you as an LP could be on the hook for that, and it could create an impermanent loss. What is your reward? Well, you're getting 80% of the trading fees. What are the exchange architecture mechanisms to prevent that from happening? They're very conservative, specifically for the volatility profile of this asset. This is real estate. The prices update once a day, right? It's USDC is the only collateral. Like, that's pretty conservative, relative to some other stuff. I know you guys have talked through some of these other, NFT perps, and there's some crazy shit out there. Like, this is on the less crazy side of that spectrum, and it still has risks, and we're very focused on them and making sure that the users understand them, because ultimately, underneath a regulatory umbrella, which is where we're all headed, by the way, to some degree, these are the things that matter. Like, you won't be able to operate if you're not thinking about these things, if you don't have answers here. And that's like philosophical. Like, if we want to play ball with the big boys, the institutions, big boys and girls, you have to have a plan to have a institutional grade product. And so I think I've covered everything that I wanted to on that. But if you guys, if I left anything untied there, Ali, I'm sure you'll let me know.
No, I think you covered everything. I mean, I think having a really strong emphasis on making sure that there's proper education for the risks at play, and also just having a punitive system for what is already like nowhere close to where we're normally at on the volatility spectrum, with like 99.99% of apps out there. So it's just, like, different rules kind of just apply to to what I initially posed, to the objection I initially posed.
Yeah.
I want to talk a little bit,
because there's a lot of. Can you hang on to that thought?
Yeah,
can I just preach for 1 second? I have a thesis here. I just want to make sure that I get this out. I've talked about it a couple times before, but perps it's like the Avengers. Perps are inevitable, right? Like, they're growing so fast, and they're like a blockchain. I think they're like the shining star of DeFi, perps. And they're Coinbase's fastest growing product. Those are regulated perps overseas, right? So they're not in the US yet. And I can give you a little bit of a history lesson, to the degree that I know it, on why that is. following Dodd-Frank, contract for difference, which is a very similar product to perps, were effectively made persona non grata in the U.S. And ironically, in the aftermath of 2008 is when Dodd-Frank was kind of put into place. As a result, all products that look like perps in the U.S., like futures and are either cash settled through a clearinghouse or with physical delivery. That's an inefficient product. There is so much overhead there that's not unnecessary, right? I get it. I get why, but it's like that is not a modern product. I would argue that physical delivery is in many cases a bug and not a feature, right? Like oil went negative in 2020 because nobody wanted to take delivery because there wasn't enough people to take delivery. So they were paying people to take delivery for them. It went negative. It got to negative $27 a barrel. That's bananas, right? And that's because, if there was a better perpetual settlement system for that asset where there was automatic roll or contract for difference where delivery was not as big of a component, that would have alleviated that pressure. Maybe it would have never gone negative. Who knows? So, all right, that's that. Perps are growing like a weed in crypto, and they're not going to stop, right? No matter what the US does, there's too much at stake. There's too much opportunity for the rest of the world, and you're seeing it. Crypto in general is being outright embraced by a lot of jurisdictions around the world. I think before the show we talked about like Dubai and the Emirates, even the United Kingdom, a lot of developed Asia. It's like, hey, we're open for business. I have a thesis that perps is going to be arguably maybe the largest value driver in this ecosystem, or one of at least. So they're inevitable. I think that means that they're inevitable that they will come under the US regulatory umbrella. The last thing I'll say is what better product to pilot if you are thinking about bringing this product, if you think this product's inevitable and you want to bring it under the regulatory umbrella, what better product than the lowest volatility asset in the world with USDC as the only collateral and really strong exchange settings, to protect all users and a track record of doing so successfully and a desire to comply and come on and to register. I'll leave it there. Ball's in their court.
Great stuff. No, I love how there's like little like history lessons or like tidbits to like dig into and all your responses. It's definitely something I'm gonna have to go back and read up on at some point. I
There's
want
all sorts of rabbit holes. I've learned this as I've gone too. Like I didn't know this shit 5 years ago, and
I'm sure, yeah, a lot of like interesting, relevant stuff. I think that is out there to look into more. I want to go back to what you said a little bit earlier, which is me personally, my favorite thing about Parcl, or like what Parcl could be, is just like the mimetic nature of trading real estate. And when you combine that with, or at least I think maybe not a good example, but I like how you talked about how you sort of had a Genesis trade, which sort of kicked off this idea for you guys. I'm curious as to if there's any like interesting trades or maybe interestingly informed trades you've seen users take using Parcl so far. I'm reminded specifically of like this one thread I saw of this guy who was like looking at like bird migratory patterns or something like that. Yeah, like autistic shit like that is like I think like the best thing or could be the best thing about Parcl. Have you seen anything else like that within your community?
Yeah, more Parcl intern who I think is watching has done a good job of like finding these. I would call them like meme. There's so much memeability here, right? There's like it's like there's like a tribalism when there's sports rivalries that you can express through this product. There's like all sorts of different bird migratory patterns, whatever you want. The Genesis trade, as mentioned, was long Miami, short New York. Not possible, but that trade from kind of inception to date, so 3+ years, is up market neutral, equal size long and short. That's up 75%. And this is an asset that does mid to high single digits in annualized volatility. Your Sharpe ratio on that trade, which is a measure of your risk adjusted performance, which at a hedge fund, like Sharpe is the only thing anyone cares about. Your Sharpe ratio is like 5 on that trade. That's unheard of. That's like an unheard of Sharpe ratio. And why does Sharpe matter? You can get a lot of leverage if you have a strong Sharpe ratio. The leverage goes up. And if you think about real estate is the most widely available source of leverage in the world. Mortgages are 5x leverage. Almost anyone can get a mortgage. Well, less so now after 2008, but like still, it's a very available, where else can you get 5x leverage as an average person? Your credit card charges you 25% for that, right? And they don't even give you 5x. It depends. I don't know. That's a crazy calculation to try and decompose. But so the point is that that real estate is a very interesting asset class to express risk-adjusted returns. So long Miami, short New York is up 75%. With 5x leverage, we're now talking like 300, 400% returns. That's a career trade. You could like retire off of that if you sized it appropriately. So now the challenge is that we didn't get the trade on. That sucks. So we got to work building a way to do it. The last point I'll make is that the even more disappointing point, and this ties to the prior conversation, is that Parcl is geofenced in the U.S. today. U.S. persons cannot use Parcl. That sucks because that trade is an opportunity that they can't get exposure to for the time being. Hopefully that changes. Nothing would make me happier. I think it's like a competitive, existential competitive thing for this country to be able to have products like this. But anyway, I've gone all over the place. But does that answer part of your question at least?
Yeah, I think that's very interesting. I think a lot of people are kind of really going to resonate with that idea.
The one thing
Yeah.
that reminds me, the one thing I wanted to add is like a huge focus for us during this time period is there's a lot of people that are new to this product, right? What is the real world utility for this product? Like, how is this not just gambling on real estate markets? And my answer is, well, this is the eye of the beholder. It's kind of any way you want to use this thing, you can. For people that own properties, that are homeowners, right? There is no way to given all the reasons we've discussed, it's in a liquid market, it's slow moving, et cetera. There's no good way to manage your risk, right? The only way that you can realize your gains in real estate, your paper gains, is to sell and relocate or downsize, or to tap into your mortgage structure, to take on more debt and do a cash out refi. And in that case, you aren't even really recognizing any gains. You're just kind of like borrowing more against the value, which has gone up. This product, for the first time, allows a third option. I own a home. The example I use is like I own a flat in London because this trade is possible today. London's up 20, 30%, or maybe since the start of the pandemic, it's up like 70%. I'm feeling good. I'm in the money. I don't want to move though. And I got a really good mortgage rate and I don't want to mess that up. So what do I do? Okay, I could take like 5x leverage, put a trade on, deposit, let's call it 10,000 USDC or the equivalent in British pounds, and short London. And that way I'm hedging my market risk. I really am isolating my exposure to my idiosyncratic property, the flat I have, any home improvements I do that has nothing to do with my short. So that's one option that's, I think, super powerful. That speaks to everyone. Like, there's a lot of people in the world that would find that useful. Another one that I like to give is like I kind of tease this, like the hurricane example. There's a hurricane bearing down on Miami. What insurer would write you a new insurance policy in the days leading up to a hurricane? None. That will not happen. But you could short on Parcl. You're going to get slippage. You're going to pay probably a pretty serious funding rate, but you can get some protection. You can get the trade on. And like that, I think is super powerful, like the synthetic insurance option. And you play this out, for people that are renters, you can create a portfolio of digital square feet and get exposure to the places you might want to live. That's interesting. So there's like all of these use cases that I really want to like frame people's minds around, because it shows that this product has a lot of versatility.
Yeah, I think you answered my question there on what kind of Parcl is aiming to be and what is aiming to allow people to do. We have 10 minutes here, 9 minutes. I wanted to discuss a little bit on kind of the progression of Parcel, but more specifically the progression of the point system. Kind of how you guys decided upon that system. Are you there? I think you lagged a little bit.
I'm
Yeah.
here. Can you guys see me? All right, cool. Sorry, I've got too many tabs open, I think. The question was on the point system, the incentives program.
Yeah.
So Parcel has a points program, which have become, as I think most of us know, like the topic du jour, or like I guess it's like the user acquisition tool of the moment. And in many ways, it makes a lot of sense. In some way, the criticisms of points I think are valid. It's like kind of antithetical. These are off chain. They can change. It's like a database somewhere. And that all makes sense. From the perspective of a protocol or a network, though, it's like what a powerful tool, right? You have this ledger of the earliest adopters, the people that are adding the most value. You can kind of screen for the people that are being extractive, and reward them at a lower rate. It provides a lot of insights to a future, the issuer of a future token. In this case, Parcel Limited, which is an affiliated entity with Parcel, is planning to launch a network token. There's now this ledger of all these early adopters that have added value, that have created value for this ecosystem. And I think that's super relevant. I think it's like a crypto, it's just like a unique opportunity that crypto has. And I think a lot of purists have criticism of points, and I get it, but I think we really need to lean into this. Like, there's not enough people here. We need to grow this pie. And in the meantime, we need to, show appreciation for the people that are here, because they're early and they're helping, create liquidity in these protocols that allow them to scale to the point that they need to really express their utility, right? If Parcel cannot provide that option to be a synthetic insurance venue or a hedging mechanism for a homeowner if there's only like $20,000 in open interest in there, right? How do you get more volume? How do you attract more users? How do you bring people in? Well, Uber had to pay me $5 to take an Uber when they first launched, right? And I was like, oh shit, this is cool, and I'm getting $5. Sweet. So I think that I'm like dancing around this answer, but like hopefully it makes sense. And I think that the other thing that's super important here is like when it comes to governance, especially within the context of network tokens. We've seen Cedo do this. They had a points program that led to the initial distribution of their network token from the Cedo Foundation, and now those are like the primary governors. Over time, they'll probably become less of a percentage of governance, but like those are the primary governance people. And what a great group of people. Sorry, I'm getting a call here. What a great group of people to have. Your earliest adopters, the people that were providing critical feedback when you were subscale, that helped you migrate from the wrong version, V2 in the case of Parcel, to a V3. They've proved themselves. They should have governance rights. They should have a say in the direction of the project. And this is points programs are one step on that journey towards like hardening that. And I think the people that are doing it best have realized that, have really good like analytics and tools to understand who's providing value and who isn't, and making sure that those people get recognized. And I think that I think that's awesome, frankly. Like I'll leave it at that.
Yeah, and well, this is the final question, unless Ellie has anything else. Completely tangentially, we talked about Parcel. Put Parcel aside for these last few minutes. You touched on governance structures. How do you, as an individual, think about the governance structure layout across the ecosystem?
Yeah, that's a good question.
This is live again, so completely up to you.
Yeah.
Completely up to you and answering.
No, I can be a good politician when I want to, I think. But It's really topical. As you guys know, you have a good view into the EVM ecosystem. There was a huge proposal from the Uniswap Foundation last week, right, around some like key governance changes to their governance structure, and there's a lot of implications of that. I think that governance is really interesting at a base layer for the reasons I just gave, right? Early users, people that have been devoted, that care deeply about the direction of the network or the project, that are power users, they have a say. That's awesome, right? Like, that doesn't exist in the traditional financial system. There's so many gates, right, for private companies. Early users. It's like Uber didn't ask me if I wanted to vote on their product direction. They just gave me $5, right? And I could provide some feedback, and it would go through some support ticket, and like, who knows if anyone read it. It's way more tangible in this structure, right? Which I think that's super powerful. Conversely, there's all sorts of side effects of that, and it's one of the big ones is that things take longer, right? Anytime you introduce like a democratic process, it just slows down progress. And I think that if you do that too soon, it's a huge problem. So you need to balance those things. But I will say that this Uniswap governance proposal is, I think, a big deal. I think in some ways it kind of signals that there's a change in risk appetite, at least perhaps at Uniswap. And that the implications, like I said, are huge, because you now introduce new ways to drive value to these networks, right? And the participants and governance participants in those networks. I think one very interesting example is like, people who participate in governance could get paid for their participation. Nothing's preventing that, right? And they are adding value. Like, they're making critical decisions. They're taking time out of their day to participate and show like deep engagement with the direction of the network and the protocol. And like, why can't all right, well, if it's possible to pay them for that service, then I think that's great. That's how I think about governance. There's all sorts of positives. There's also these externalities. They need to be thought of. They need to be given equal weight in the decision-making process. I think to introduce governance over too much of a network too early could potentially like catastrophic mistake. But when there's some semblance of scale, governance makes a ton of sense. And I think if there's a way to drive value through governance, that can really create like a powerful system for this whole industry.
Yeah, that's awesome. I think I'm really enjoying kind of the next phase of a lot of programs going from points to really thinking about this new age of governance. I know Anders from Margin Fi's into Feudarchy or however it's described, and those systems are super interesting. But yeah, I'll be conscious of time here. That's all we got for today. Is there anything we may have missed, or any like call to action you have for some of the listeners?
No, I think we covered a lot. There's probably some good clips here. Hopefully it was valuable for you guys and the listeners. I think the only call to action is to explore these projects, particularly Parcl, obviously, but and to learn and to educate and to understand how they work and the risks associated with them. Once you do that, advocate for them to be available to more people, right? This is the future. I think we're all here because we believe that. Let's convince other people of that, and let's do it in a responsible way and make this technology, which is super powerful, available to more people.
Awesome. All right, that's episode 57. Appreciate you for coming on.
Great
Thanks
stuff.
for having me, guys.